Hello, everyone. Thank you for joining me today. My name is Eamon Gebre, VP of Investments and Advisory here at Sarwa. Today, we're going to be discussing Black Swan Protection Protocol. And to join me in our conversation is Mr. Michael Chu, Head of Investments here at Sarwa. Thank you for joining me today.
Thank you. Really happy to be here.
Well, pleasure's all ours. I want to start at the very top, Michael. What exactly is Black Swan Protection Protocol?
The Black Swan Protection Protocol, or BSPP for short, is a unique form of protection for when the markets experience an extreme rapid downturn. BSPP was created by Universa Investments, and they deploy an options-based hedging strategy to help offset potential losses during extreme market stress when traditional approaches to protecting your portfolio fall short.
Now, it's not the first time we've heard this term before, Black Swan. And I don't blame certain audience members who might think of Natalie Portman and the Black Swan movie. But really, at the end of the day, what is exactly a Black Swan event and who popularized it?
The term Black Swan was popularized by Nassim Taleb, a Lebanese-American mathematical statistician, a risk analyst, and a former options trader, who authored the book titled The Black Swan, which explores the impact of rare, unprecedented events to financial markets.
Okay. But how is that relevant to what we're discussing today?
BSPP is based on principles developed by Nassim Taleb. He's an advisor to Universa, and he spent most of his career studying and developing strategies to help protect against extreme but rare market risks.
Okay, I see the connection here at this point in time. And I feel like we're maybe getting ahead of it ourselves. Maybe let's take a couple of steps back, okay? Can we define what is a Black Swan event?
We can. According to Nassim, Black Swan event is characterized by three main attributes. The first one is rarity. They are extremely rare, often beyond normal expectations. 2, impact. They have a massive impact on the social, economy, or markets. And 3rd, predictability and hindsight. Often after the event, people rationalize it as predictable, but they weren't.
But it sounds, quite close to every other market experience or market volatility we've ever experienced in the past, right? I mean, what's a key differentiator between a Black Swan event and typical market volatility?
Severity and speed of impact on the stock market.
Okay, tell me more.
For example, if the S&P 500 were to drop 20% in a given month, that most likely would be categorized as a Black Swan event.
Okay.
Throughout history, we've had similar events or even larger losses, and most of them have been categorized as a Black Swan event.
Yeah, and I can see the differentiation between a sudden drop versus an extended drop over an extended period of time. Maybe we can talk about a few examples that we've seen in recent history.
I've got 3 examples for you. First is Black Monday, October 19th, 1987, where we saw the Dow Jones lose over 22% in a single day, which was the largest in history. Next, we have the dot-com bubble, which from March 2000 to October 2002 saw the NASDAQ fall 78% from its peak, and the S&P 500 dropped 49% from its peak. Now, this also was the start of what we call the lost decade, where investors invested in the U.S. stock market really saw negligible returns in that 10-year period. And next, after that, we have the global financial crisis in 2008. This also happened in the latter half of the lost decade. This saw the S&P 500 drop over 27% in a 4-week period and finish off the year at minus 50%. The great global financial crisis was triggered by the collapse of Bear Stearns, which caused a domino effect. It led to Lehman Brothers filing for bankruptcy, which was the largest in U.S. history. And then other companies followed suit like AIG, Countrywide Financial, and IndyMac. All in all, about a total of $10 trillion was wiped out in global financial markets.
I remember that period quite vividly, and I would imagine you did as well too. I think we were both relatively junior advisors at the time, fresh out of the theoretical work that we have done to get ready and understand and give advice to clients. And I remember it being a very challenging period. I noticed that you left out the COVID-19 pandemic.
Yes.
Any reason why?
It on purpose.
Oh.
So it was driven by global panic to the COVID-19 pandemic, which resulted in unprecedented market volatility and massive drawdowns.
Mm-hmm.
But this wasn't totally unforeseen. According to Nassim, that this isn't a black swan event. He coins it as a white swan event because these events were predictable in the sense that because we're so highly connected in the global world and we've seen near misses with pandemics in the past.
Mm-hmm.
So they were predictable.
I mean, we've had several pandemics, not only within our lifetime, but also prior to as well, too,
Yes.
right? But nonetheless, what you're saying is it's just more of a definition. There's a difference between the events that we saw in COVID-19, where that would be defined as a white swan, whereas those other examples that you've given were a black swan, but the impact was nonetheless quite severe.
Yes.
And in this case, the hedging strategy that we were talking about for Black Swan Protection Protocol would still apply in that event.
Yes, it would.
Speaking of the impact to investors, I mean, it's beyond the numbers. I mean, at a certain point in time, when you're thinking about minus 20, minus 25, minus 30%, I mean, there's real world implications to this. Maybe you can speak to what the impact is for individuals who go through these extreme events.
A lot of clients may have faced delaying or jeopardizing their financial goals, having to invest more to reach those goals, or take on more risk.
Okay, fair enough. And that's quite challenging because in some situations you don't have those options available to you, such as putting in more money to recover or to make up the gaps altogether. It may mean essentially having to work longer or making tough decisions, such as, hey, maybe I may not be able to subsidize the entire cost of your university for their children. And that's a tough conversation to have. And really tough to realize that at that moment as well. Also, there are certain scenarios in which we exasperate the implications of a negative market.
Yes.
There's certain decisions that we make, unconventional decisions that we make due to panic.
Yep.
Maybe we can talk a little bit more about what are some of the decisions that we make that tends to impact us even more.
So unfortunately, during extreme market stress or volatility, investors succumb to human biases, and they tend to sell at the bottom, exiting the market, and they may never re-enter the market. This is one of those human biases are what we should be avoiding when we're investing for the long term. We always recommend clients to invest early, invest often, and stay invested even during periods of extreme market volatility. If you're invested in a globally diversified portfolio, just stay the course. If you're systematically investing, maybe double up those investments. And if you're not adding to your portfolio, maybe now is the time to add to your portfolio. The worst thing that a client can actually do is exit the market at the bottom, because most of the time they may just end up sitting on the sidelines and missing out on any upside rallies.
Yeah, no, it's fair. And look, it's understandable. And I think a lot of investors know this going into investing for the long term. But it's just in those moments of extreme, I would say, volatility in the markets, it does unfortunately create a sense of panic. And sometimes we're not thinking rationally in that point in time. And it doesn't really help that intuitively, I think many of us don't really understand the impact of a market drawdown and how much it will take to get back to parity as well too. For example, if a portfolio was down 5%, people naturally assume that the portfolio needs to grow by 5% to break even, but that's not exactly the status there, is it?
It's 5.3%.
Oh, to be exact. Thank you very much for that. Maybe give us a little bit more light on this, actually.
So now that you've started with the numbers, it just comes down to the math.
Okay.
If you're down 10%, you're right. If you had a return of 10%, you wouldn't be coming back to even. You'd need a return of 11.1% to get back to your portfolio start. Okay. If you're down 20%, the return required is 25%.
Okay.
Now, 33% required return is 50%. And then at 50%. If you suffer a 50% drawdown, the return required is 100%.
Right.
That's 100%.
In those extreme examples, it's a little bit easier to better understand that if your portfolio is down 50%, you essentially, if you had a 50% rebound, they're halfway there.
Yep.
Another 50% to get you back to parity.
Correct.
And that takes time.
It does.
Right? I mean, we've seen some of these drops are quite steep, but the recovery tends to be quite elongated essentially the bull markets tend to be long and drawn out, and bear markets tend to be quite aggressive in drops themselves. But thank you for kind of painting a picture for us that I don't think necessarily that we thought about, nor that we wanted to think about really. But traditionally, I mean, investors have been exposed to bonds as a hedge against this market volatility.
Yeah.
Are you saying that this may not necessarily be the most effective approach?
I mean, bonds and equities are traditionally negatively correlated. So that means when equities fall, bond prices tend to rise and vice versa, which has made traditionally bonds a very good diversifier in normal market conditions. Mm-hmm. But what we've seen is under economic stress or uncertain times or high inflation, we've seen both those asset classes turn into positive correlation, which means that they move in the same direction. If you're investing in bonds with the idea that they would cushion or give you a buffer or negatively correlate so that when your equities fall, the bonds portfolio would offset some of those losses, that's great, but it doesn't always work. 2022 was a prime example of that, where we saw both bonds and equities correlating in the same direction. U.S. bonds returned negative 16.1%, and U.S. equities returned negative 19.5%.
That was definitely, marked by the fact that interest rates had gone up in such an aggressive fashion within a short period of time. And that has an inverse relationship to bonds. And thus, that's exactly what the result was. We saw the returns being negative on bonds. Mm-hmm. So I want to bring the focus back on Black Swan Protection Protocol, BSPP for short. Save me the mouthful altogether. How would BSPP have made a difference in those extreme market events that you mentioned earlier on? Whether it be the Black Monday, whether it be the 2008 financial crisis, for example.
Basically, just a 2% allocation to BSPP would have protected 100% of your equity portfolio. Now, for example, in 2008, had you had BSPP in your portfolio, you would have realized a gain of 24.5% versus an unhedged S&P 500 portfolio realized a loss of 30.5%.
Oh, that's quite an extreme difference there.
Yeah.
And what you're saying is essentially had you had an allocation for this hedging strategy, the difference could have been quite significant, either extremely happy with a positive return or extremely disappointed with a negative return as in line with what we saw in the markets. Okay, so then long term, what does a portfolio look like with and without BSPP?
Okay, well, for example, if we took from March 2008 up till July 2023, a portfolio with that 2% allocation to BSPP and the S&P 500 would have realized a compound annual return of 14.3% versus an unhedged S&P portfolio realized that compound annual return of 10.6%.
So while being protected, you also have the benefit of having upside potential.
Yes, there is no cap to the upside. And we can see in this illustration that really avoiding those major drawdowns increased your performance.
Well, then I want to jump into the mechanics of Black Swan Protection Protocol, right? How does it work? What's the actual underlying strategy that's being utilized? Maybe we can spend some time talking about that.
BSPP involves buying far out of the money options on indices like the S&P 500. These options are generally cheap because the market crashes they protect against are viewed as highly unlikely. Now, in the event of a Black Swan event, these options would be in the money significantly, and the payout would be like an insurance policy. Do you remember the movie The Big Short?
I do, yes.
So in The Big Short, they were buying credit default swaps
Right.
for next to nothing.
Right.
And the banks were willing to sell them as many as they wanted because they viewed the probability of default to be highly unlikely. Similar idea. They're cheap options because whoever's selling them, they don't believe that the probability of that event happening would happen.
Because these are outlier events, really, at the end of the day, right?
Tail risk.
Tail risk,
Yeah.
exactly. Tail risk hedging altogether. And as unlikely as they are to occur, but should they occur, they're quite devastating. And hence, that's
Absolutely.
why this solution exists altogether.
So the goal is trying to avoid those massive drawdowns while still allowing investors and investment portfolios to participate on the upside. If we look at the lost decade, this is a period between January 2000 to December 2009. In that 10-year period, the S&P 500 realized an annualized return of minus 0.95. Of course, this included the dot-com bubble and the global financial crisis. Now, the decade after that, from January 2010 to December 2019, investors realized a return of about 13.3%. So that's a big difference between the two decades. Now, if you're invested for that 20-year period, you would have realized an annualized return of 6.06%. So if we were able to avoid that lost decade because we had some sort of protection in place, those return numbers would be significantly different.
That makes sense, absolutely. And that's assuming someone actually had the patience and discipline and perseverance to remain invested after that lost decade. Because I would imagine for some, they get to a point of capitulation where they just are not interested in investing anymore.
Uninterested or just depressed or feeling the pain.
Yeah.
So the worst thing an investor could do at that point is really sell out, move to cash, sit in bonds, and more likely than not, they will miss that recovery rally.
Yeah.
And then their chances of recovering any of their losses is next to nothing.
Let's bring it down to, let's talk a little bit more closer to home about Sarwa and how clients essentially can, take advantage of the Black Swan protection protocol.
So Sarwa clients can have the option to protect the total amount of their Sarwa Invest account or their Sarwa Trade account or both. And we will be giving them an option to protect slightly more or slightly less than that total amount. And the charge is going to be 2% of their total portfolio value that they want to have protected.
Now, when you say charge, I mean, where is that 2% going?
So that 2% premium will be going to pay Universa to manage the protection and also to pay for the options premiums that will be used to protect the portfolio.
I understand. And so it's 2% of the amount that we are protecting, essentially. So whether it's a balance that you have on Sarwa Invest or Sarwa Trade or a combination of the two, you essentially can opt in to have a total coverage.
Correct.
But keep in mind, so the Sarwa Invest portfolios are globally diversified. You have exposure to emerging markets, developed markets. You also have some bonds in there, potentially some real estate. So how does that fit into the framework here of BSPP?
So the Black Swan event would be essentially a 20% drawdown on the S&P 500. Now, Universa's BSPP protects against drawdowns on the S&P 500. I know investors are globally diversified, but most developed markets are correlated to the S&P 500.
Essentially, so if we see a sudden drawdown, there's a high likelihood that it'll also have a domino effect onto other markets as well, is what you're saying.
Yes.
And so this solution, although it essentially focuses on the S&P 500, just by way of that, by proxy, you can have overall protection of your portfolio. And then whether that be Sarwa Trade or Sarwa Invest, really, at the end of the day.
Correct.
Okay, not fair enough. What's the timeline for coverage here?
Coverage will be for 12 months or 1 year from subscription date. And the premiums are non-refundable. So once you pay, it'll protect you for the next 12 months.
Okay, fair enough. Is there flexibility to withdraw from my portfolio during this period of 1 year?
Yes. There are no lockups on your portfolio. It's essentially your insurance premium for your portfolio. Once you've paid, it protects your portfolio for that protection amount that you've opted for.
I see. So if I do withdraw at some point in time before the year is up, that coverage still extends until that timeline, nonetheless.
Correct.
Do I have the option of maybe topping up this BSPP protection throughout the year?
So at this time, it's just going to be an annual subscription. At future dates, we'll be looking at adding more frequencies for subscriptions in between subscription and renewals.
Okay, fair enough. But then suppose that the strike date or the date that we proceed with this is January the 1st, for example. I can deposit prior to, though. So if there's a balance I would like to invest into the markets and I would like that to be protected under the cocoon of Black Swan Protection Protocol, that option does exist for me.
Correct. We will need that. We'll need clients to have all their assets that they want to have protected, custodied with Sarwa.
Fair. And is it an expectation that you have to follow through? So when this comes to maturity a year from now, is there an expectation that you automatically renew, or is it an opt-in?
It's going to be an opt-in.
Michael, this has been a brilliant conversation. Thank you so much for making the time. As we wrap up this topic, what can Sarwa users expect from a communications perspective on Black Swan Protection Protocol?
Yeah, absolutely. They will be seeing this podcast, other webinars addressing BSPP, email campaign, brochures, and presentations.
Yeah, absolutely. And for those who are watching this podcast at this moment in time, I definitely would encourage and welcome you to book an appointment with your advisor. Even if it's something that you're just curious about or you want to get the finer details, I definitely recommend you having a conversation with your advisor, book a calendar with them as soon as you're available, and we'll be happy to walk you through it. Michael, it's been a pleasure.
Thank you so much.
Thank you for giving us your insights, and I hope to see you again.
Absolutely.
Have a wonderful day.
Thank you.